Hey guys, this is Colin Keenan with 3T Futures and DTI. Michael, you can, or Jeffrey, you can adjust it on your end. I've got it as high as I can go here. Um, we got a nice little treat for you coming up here today. Chip Frame of Nadex is going to come on and give us a nice introduction to Nadex and a nice binary options overview. So I'm going to get his slides ready to go for him. And Chip, if you notice, I don't know if you've ever used Novia before, but you've got some arrows here at the top that will take you through your slideshow. So make sure you use those arrows, and that'll get going. But before Chip comes on, guys, I just wanted to kind of give you a little, give you my perspective on Nadex. We have been working with Nadex for a little over a year now, working with Chip and the fine people at Nadex, and we've really seen a pretty big explosion in the demand and the I guess the demand and the expansion of Nadex and what they can do and who they've reached out to and whatnot. When we were first getting involved with Nadex, nobody really knew much about them. We didn't really, um, we understood the concepts and whatnot, but really didn't understand how to apply, how to use the application and whatnot. And since then, we've really done several webinars. We do one webinar a week at least on different strategies, different opportunities, looking at different opportunities in different markets, and it's been a very positive venture that we've taken in looking into Nadex. A lot of people here that work with 3T Futures are involved with Nadex trading on a regular basis. Some people have made it their primary method of trading. I think the most popular form is people have really used it as their as a supplement to their already futures account or the trading that they're already done in their futures account, and that has worked as an excellent supplement as well to a regular futures account. So there's a lot of great opportunities, a lot of good things about Nadex that you can really take advantage of. Um, and so I just wanted to let everybody know, kind of from coming from a brokerage perspective, people who are involved in the business and involved in different trading platforms and different methods of trading and whatnot. Just want to let y'all know how valuable it's been to help us grow our business and also hopefully help Nadex grow their business as well. So it's been a really good relationship that we've had, and we really appreciate everything that Chip and all the guys at Nadex do for us, and so just wanted to pass that along to you guys and let you know how much we appreciate these guys helping us out, and hopefully, you guys that'll translate to you guys also, really stepping up your game as far as trading goes, and really getting as much out of the trading day as possible. And we really think that Nadex gives everybody an advantage to doing just that. So, anyways, guys, Chip, if you're there and you can hear me, the room is yours, bud, and just come on in. And like I said, these arrows at the top of the page right there will help you navigate through. And without further ado, guys, let's let Chip come in here and take it away, Chip.
to elicit U.S. persons, people to buy or sell these binary contracts unless they are listed for trading, a trading exchange in the U.S. And fortunately for us, from the CFTC website, here it is. This is the DCM. This arrow key is killing me. This is DCM. Essentially, this is a fancy way of saying we're an exchange. There we are listed, the status, and here is the DCO where we're the clearing organization. We're self-clearing. So what is Nadex? Well, it stands for North American Derivatives Exchange. As I said, we're DCO, DCM. This is good for the active trader, the individual, the retail, the guy who wants to get in there to test it out. We offer essentially 7 different stock indices, 7 different commodities, 8 different currency pairs, and you don't have to buy a seat to trade on our exchange. All you do is fund your account. Again, they are limited risk when you're putting on the trade. Low entry. You know, I think to open up an account, it only costs you $100 to become a member. So why is this important? Well, it's no margin calls. It makes it's appeal to the masses essentially. There's a lot of opportunity because we offer a lot of different time frames for these products, and it's pretty interesting. So what is a binary? Well, these are limited risk products. Essentially, you have to have an underlying market, an expiration time, the duration. We have binaries that go from a week out down to 2 hours, and then the condition, the statement. I keep on missing this. Then you can go long or short, buy or sell. It's going to cost you. Entry of the trade is going to cost. So the initial trade is there's a cost. It's limited risk. It's also a cap on the profit potential. It's worth $100 at expiration. The pricing scale trades between 0 and 100, and it's all about the relationship where the underlying is relative to the strike price. Now, this next point, all or nothing with binaries. They have that term. It is worth $100 at expiration, but you can, if it's worth $100 at expiration, but you don't necessarily have to hold on till expiration. If you bought it at 20 and it's trading at 10, you can get out and lose only $10. If it's trading at 60, you bought it at 20, it's trading at 60, you can get out at 60, i.e. you pick up $40 net. So, but it's just on a different trading scale, okay? So what is a binary option? It's essentially this statement, true or false, okay? If it's true, it's going to, if you agree with the statement, true, and it settles at 100, the buyer gets up $100 at expiration per contract. If it's false, then it settles at 0. The pricing actually, because it's out of 100, it relates to the price of probability. And we'll talk about that more. And these are like traditional options, time, volatility. All this is factored into the price. Okay, so here's a couple examples of some binary statements. USD greater than 0.9600 11 a.m. This is a statement. This is based on the actual spot Aussie USD. And this is the price level, the strike level. Is it going to finish over this strike, yes or no, on this date? The German 30, that's the Nadex name. The German 30 actually is the DAX futures contract, the June contract. Again, here's the price level. It's like the line in the sand. And this is just a few examples. Now here, we'll run through. There's, as I said before, there's 7 stock indices. These are that are offered on Nadex. The underline is the futures contract. In the black, that's the Nadex name. And the blue, that's the actual underline and what exchanges they're traded on. Okay, and all this is in our homepage. If you, depending on how familiar you are with our products, it's all in our homepage and under in the information area under range of markets. Actually, 7 different commodities, same kind of thing. The underline is futures, and then on the currency, the forex, that is on the cash market, the spot. Okay. So the binary price. Okay, so here is to the left here. I hope you can all see it. That's generally just a market. Okay, so the binary price, the market, as I said before, we're kind of building this, rehashing it. The binary trading price is going to trade between 0 and 100. That's the scale. At expiration of the contract, if you bought the contract, you want it to expire at where? 100. It will finish at 100 if the underline finishes over that strike level, that you agree with the statement. If you're a seller, you want the binary price to settle at 0. Okay? So, but the price is on the binaries are dependent on time to expiration, volatility, and the differential between the strike compared to the underline. So let's first take a look at the underline compared to the strike price. So we need a price level. So let's just say here's one. This is the strike price, and the market, as I said, is right here. Right now, who has the advantage? Right? Who has the advantage? Buyer of the binary. I want it to. Oops. Keep on. I want it to be over that strike. This strike price. Think of it a line in the sand. If it's a seller, I want it to finish below. Okay? All right, so there's the strike price. There's the underlying market right now. So that differential, there's an advantage. Who's got the advantage? Well, it's obviously the seller has the advantage because right now the underlying is below this strike price. You want it to finish below the strike price. So this advantage, though, well, we won't get there yet. Oh, so right now, here's the timeline. Oops. Here's the timeline. When we put it on, you may have the advantage, and I'll have you, and as we all probably all know, you have to pay for that advantage. But will it finish? How's it going to finish at expiry? Okay. That's the big question. So what should the binary price be? You know, here's the strike, here's this price differential. The seller's advantage has value. Okay, so there's a trade-off. This value means you're going to end up putting a higher proportion out of the 100. Okay, you're paying for that advantage. And obviously the buyer is at a disadvantage. So proportionally he's going to put up less money. A way to always remember here, these contracts on Nadex are fully collateralized. So the buyer's cost, the seller's cost always are going to add up to 100. Okay? So here, let's just take another example from where the strike price is below the actual underlying market. Okay? The buyer obviously has the advantage right now because as a buyer, you're saying, I agree with the statement, I think it's going to finish over the strike. So as a result, we went through proportionally all that stuff. So let's say that, oh, I'm not here yet, sorry. I got a little confused on my slides here. But so another way to look at this is the binary price can be viewed as a probability, another way to think about this. Okay? Out of 100, you're paying a portion, a higher proportion. So let's say the price is 80. So what that really is saying, it's an 80% probability. Okay? Right now, that's what the market's saying, that the buyer has an 80% probability that he's going to get the $100 payout at expiration. As a result, it's a cost of $80 per contract. Now the seller And that's right now. Does it finish that way? That's the big thing. At expiration. A seller at 80, he shorted 80 trade prices at a disadvantage, and it's essentially the remainder to add up to 100, or another way, 20% probability, or 100 minus the trade price, which is $20 per contract. Again, combined, it's fully collateralized. So the actual probability on binaries is going to be the bid offer the midpoint. Okay, so at 75 at 77, the buyer is going to have a 76 probability. The pricing on binaries are in buyer's terms. So it's 76% probability for the buyer. It would be a 24% probability for the seller. And we will show you some slides here, but the binary price does not move linear with the underline. And I got some excellent slides later to show you this example. And again, as we said, time and volatility can impact this binary pricing. So here is time. Okay, now what I did here was I pulled up 3 different order tickets with 3 different durations, expirations. Okay? And as you see the price, it's difficult to get them all for the same price. But as you see, I'm just going to say these are real close to 80. Okay? I want to say they're all about 80% probability on this. So the first one here, and the spot is all at the same price, is like 130. Well, the slides will show me. I can't read it from my thing. But anyway, the spot price on the euro is all the same on the 3 tickets. And so the first one we're looking at, this expires at 11 a.m. and when I pulled it, it had 30 minutes left prior to expiration. So this ticket here, the strike is 134.16. The spot rate was 34.25.9. Essentially, it's almost 9.9, almost 10 pips of advantage. Buyer has that buyer's advantage, the difference between the strike and where the spot is, insurance, whatever you want to call it. But it's going to expire in 30 minutes. So you're essentially paying, on this one, pay 85 to make 15 if you're lifting the offer. Okay? It's a choice. But this is going to expire in 30 minutes. Here's another one. The second one, this is going to expire at the end of the day. This was a 4.5 hours left prior to expiration. The strike's 34. The spot is still the same. That's almost 26 pips over. So I'm essentially, my advantage to put up $80 or $82.50 of risk to make the difference of the net of $17.50 net for 4.5 hours risk. I'm given, I want this kind of advantage, almost 26 pips. So these are all choices, and actually all these different strike prices, all these different durations, it's just what do you feel comfortable with on your market view, of your underlying market view, and keeping in mind that it's going to expire at this time, and we do have to talk about the expiration, how that impacts the pricing. And the last one, is a weekly. That end of the week, and as it turns out, 3 days, 4.5 hours, and that's almost 101 pips of advantage. So essentially, you are putting up $81 to make 19, but right now it's in the you have that intrinsic value. It's already over to your advantage, 101 pips. So it's a choice. Okay, time. Okay, and this is just a visual of all of them compared. The first one was 10 pips relative to where the underline was. Second one, 26 pips. Just another way of showing. We've been all over that. So let me show you here, essentially, how the pricing will change here. All right, so let me get on here. So here's the underlying market timeline. Here's a strike. It's the Euro USD 128.80, end of day, 3 p.m. And so here we go. Right when we put on the trade, it's over the strike price. Okay, over the strike price. And since it's over the strike price, remember, rule of thumb, underlying trades at the strike, then it should be around 50. So it's right now it's traded 54.58. All right? The underlying market goes below the strike, it's 42 at 46. Still, it's a far way to go before you, hang on one second. Can everyone hear me, just to test? Okay, good. All right. I just got paranoid for a second. The phone rang here. Okay, so the underlying now is below the strike. So it is priced at 42 at 46. Now notice the distance here. It's approximately the same distance apart there from the strike. Okay, but still far away from the underline. Now, if we go a little farther, now it is 34.38. Okay, now remember, it's about probability. Look, it's much closer to the expiration here. So it's for the buyer, he's lost value. It's priced 34.38. So it's really the market interpretation. Who's going to get, what's its value? Who's going to get the $100, the buyer or seller? And you see there, essentially the underline is pretty close to the same level, but time has passed on, and that's how how the pricing is being affected. And then if it goes over, again, it's accentuated because it's closer to expiration. Now it's 72 at 76. It's closer to that expiration, and you can see how this thing moves. It is for sure worth $100 at expiration. It's just, is it going to be over that strike price or not? Yes or no? The line in the sand. And there it's above, it settles at 100, buyer would get the $100. So what about volatility? Okay, so high volatility, low volatility. How is that affecting the pricing? Okay? So again, here's a scale. Now if you think about it, high volatility, hang on a second. High volatility, no one really knows, is it predictable? No, it's not. It's difficult. You don't know. So what that means is it's going to end up trading in this area, in the middle. Not every strike is, but it's going to be skewed towards the middle because it's not predictable. It's harder to predict because high volatility. Now, if it's low volatility, is it predictable? Well, the binaries that are in the money, kind of in the wings, where it's buyer advantage, seller advantage, that differential, where it's over, it's under, in the money essentially, that is going to be more predictable, these areas. And so the concept is essentially this. Here's the strike. There's the market. Underline's already over the strike. So here it's trading 52 and 56. These are in the money, and it's just kind of a race to expiration. It's in the money, and the idea is that the lower the volatility, the expectation, low volatility, it's already in the money, payouts going to the buyer in a case like this. Okay? Expiration, $100. Okay, so here's the platform, the Nadex platform. I do apologize that we're only showing the, it looks like the stock indexes. We offer all those products I told you about before. I need to update this one. But this is the basic platform that we have here. And the next slide will essentially you drill down in the finder window, and here's all the different. It's an option chain. It's a slew of choices. Okay. So once you choose the option that you want to click on, you get the option ticket, the binary option ticket. Here's the statement right there. There's the bid offer. Here the direction, it's a buy. The ticket on our direct model, it shows you the contract size, the price. Here it shows you 26. Price is 26 to buy one contract, so max loss, max profit is 26 to make 74 on the net. Remember, risk reward. For the buyer side, it's 26 bucks in red to make the 74. The seller's putting up 74 to make 26. So it flip-flop. It's the, true, false, right? True, I agree with the statement. False, I'm a seller. So another visual here. Here's the different market. It's the US 500 SEP, greater than 1309. Here we got a buyer at 33. Seller's going to sell it at 33. It costs the buyer 33 bucks. It's going to, okay. Seller's going to have to put up 67. Combined, 100 bucks goes, there the exchange has it. Contract expires at 100, so buyer's getting the $100. That's how it works at expiration. Net 67 less fees. Seller gets nothing. So here's a chart. So let's say we are bullish, okay, and we're using binaries. We're thinking the market's going up. So essentially, here's on the right here, all these strikes are binary possibilities. All these offers are possibilities. It's just cost you. The cost is the price that's circled there in the triangle. Your net profit is going to be the difference from 100. So the question is, how bullish are you? What's your target? Okay, so profit target. Let's go. Let's say it's there. I'm just, this is just picking stuff. So we're saying it's going to be at this level here. Okay. So I think that actually I cannot see worth a hoot here on this screen. 1 second. Okay, so let's say it's 1169 is that level. Okay? And so if I want to buy this contract, I think the market's going to rally from this point right here. So I buy it. It costs me 10 bucks. My net profit at expiration is 90. That is a 900% return. Essentially, this is like an out-of-the-money call. It has to move above that line or finish above that line at expiration. And I will tell you that we'll talk about this later. But if this is where you think it's going to go, it has to finish over. And so you're going to see some major volatility, which some slides later will show you this, and you're probably going to get some gray hair while you're doing this. So you could get out of it early, because as this underline goes towards a strike, it's going to increase in value. Remember what I said earlier: underline trades at the strike fair value. With time, it means it's going to be trading around 50. So you bought a 10, it's trading 50. That's still a nice return. But if you're going for it all, you can lose it all, you can make it all. So another strategy could be, let's take it down a notch. What if we use that strike instead? Okay, so make it a little easier. Now we're going to pay 15.5, 84.50 net, and it's a 54.50 or 545% return. Okay, out of 100 on per contract. So it's another way to look at it is out of the money calls, at the money calls, in the money calls. So it's really about what's your opinion of the underlying cost to return what makes sense to you. So here, it's just another choice. For here the underlines right here. Here's our strike. It's not that far away. It's not that far for an out of the money, just slightly. Again, 43 bucks. Or here's one that's in the money, 74.50. So just doing the comparison, it's trading choices. 43 to make 57, 133%, or a 35% return on where we're putting up more money. But we have that advantage, that advantage that underlines trading already over the strike. It's in the money. Okay, what we can do it the other way. What if we're bearish? Same kind of thing. I mean, it's just it's puts, long puts. We're selling the option. It's a false statement. It's not going to be over the strike. So all these bids right here hit in the bid. And actually, remember, your cost is going to be 100 minus trade price. This would be the trade price. So all these are you in the advantage or not? You have the advantage because you're saying that the underline is going to be trading below that strike. All these strikes, the underline's already trading below. So seller's binary cost, 100 minus trade price, right? Just for a quick example, 350, that's the trade price. So it's going to look how much money we have to put up for that contract. 96.50 to make 350. Okay, we get something a little closer to the market, 29 trade price, 71 bucks you got to put up. So it's really all about its choices and your view of the underlying market. After you learn the mechanics of this, it's a trading choice. But the nice thing about binaries is defined risk, defined payout. For sure, at expiration, this thing is worth $100. Other instruments, you don't know if it's worth $100. It's variable. Right here is right at the money, 50. Pay 50 to make 50 if I'm a seller, hidden the bid. Neutral. And these obviously, do you have the advantage? No, the seller is at a disadvantage. So if you're at a disadvantage, it's going to cost you less. So here I'm looking at the 86 trade price. It's going to cost me 14 bucks to put on that trade. 14 to make net 86, but the market's got to drop where it's currently here. It's got to drop down to here, whatever strike that is. Okay? So some strategies here, what you can do. I mean, it's just directional outright buy sell, but here's some other things you can look at. So what if you're looking for flat markets, sideways, neutral, etc.? Market's just going to move sideways. Okay? Well, one thing you could look at is selling the higher strikes, buying the lower strikes. Okay? Essentially, these are both in the money. Each leg of that is in the money, so it's going to be a higher cost initial out of the higher portion out of the 100. Okay? So if I sell the 39 strike there, or I sell the 39, whatever strike that is, and I buy this one, 65, I'm basically collaring the market here on a sideways movement, but it's tight. So this total cost of this position, 2 legs, is 126 bucks. Okay? So what I'm looking for, sideways movement, I'm looking for the market to stay right there in that collar. So if it finishes anywhere between here, I'm actually going to get a double payout. I win on both strikes. Okay? Now, if I am wrong here, the nice thing about this, although it's a lot of money to put up. If I'm wrong, one leg is always going to always have a payout. So the net cost there, the net loss would be 26. Okay. Now another way. Okay, so sorry about that. As I said, these are in the money. So we kind of went through this slide before, but so you'd be from the long side, short side. Again, these are in the money. We've gone through this exercise before. It's in the money, and it's a race to time. You want time to work in your advantage, and here's just the reverse of that. Here's where the underline is already below. As a seller, we have the advantage, and again, time is working for your favor. It settles at 0. You get the payout. But on that same strategy, the total cost here was 126. Now, this is a tight range. Now, if we widen that range and do the same thing. We're selling 12.5, buying 89. So instead of a initial cost of 126, it's 176. So probability, think probability. We are increasing our chances of the underlying finish in a bigger range, so that's why it costs us more. If we have a probability, if we have the advantage, that's why it costs money. It is a fixed payout. It's worth $100, and so it's always a proportional thing. Okay. Now, another thing they can do with binaries, especially when you get some big number days, Fed announcement, whatever, you don't know which way it's going. Big volatility, who knows? So one thing, a strategy, you know, obviously you can try the out of the money's directional, but another way to do it is to put it on both ways. So essentially, what you're doing is you're buying like an out of the money call, out of money put. Okay. You're looking for something. So you're looking at the higher binary strikes, buying those. These are possibilities. Selling the lower strikes. These are possibilities. Now, obviously, the farther out you go, the cheaper it gets. So say we buy that strike, that costs us $10. Say we sell that strike at 86, what's that do? That's going to cost us 14. A total cost for this position is 24. So you have to keep in mind that the cost is 24, so it is 24 plus 10, 34 is your break even on the upside. So you need the market movement where this binary is going to be priced at least 34 on the announcement or the big move. That's your break even. So if you're looking at this type of strategy and say it's unemployment, but remember how the skew goes towards 50, there's probably going to be a point where it's too expensive because the underlying might not move far enough for me to get that break even. Ideally, what you want, here, let me just finish before I go on. So the break even on the downside is 62. 86 minus the 24, we need it to go to 62 to scratch on either way. So what you want is the underlying to have enough movement to exceed these break even points, and then you'll want to get out of the trade, because you can the payout's only going to be good at expiration for one side or the other. So essentially what you want to do is, get out of it on the big move, and then you've covered it, and you then have a free option on the opposite direction, and you hope for that movement to happen. Okay? But it is something you want to keep in mind, is the total cost. Okay? And lastly, if you don't liquidate the binary position, you have that option. Don't forget, it is not required buy and hold. The Nadex calculation. So what happens is, whatever the underlying product is, if it's futures or if it's FX. If it's futures, we're taking the last 25 futures trades right before the expiration time. We get those trades, sample set of 25. We take the 5 high, the 5 low out, middle 15, simple average, and we carry it actually one more point, and then that is the number. That is compared to the strike price. So if the buyer, if that strike price, if that settlement value, expiration value is greater than the strike, then the buyer gets $100. If it's equal to the strike or less, seller gets it. Okay? It's done over and over and over. So that is the methodology. If it's a currency, currencies aren't traded on exchange, so we're using the cash bid-ask spreads. I don't want to misquote it, but there's certain width requirements of bid-ask spread, and it's then a midpoint, same process, 25 midpoints in same process. This is all in the rules section that you can find out about it for the actual specifics if you need to know on that stuff, okay? And then finally, if you do hold the binary going into the close, and it turns out where the underlying is real close to that strike price, it can be a huge gamma play. So what ends up happening, you can have some big swings, and essentially a small percent move of the underlying price action can have a huge price action on the actual pricing of the binary pricing. Because think of it, it's getting pulled from 0 to 100, okay? So here is a 15-minute chart. This chart is the pound dollar, I think. 1 second, I want to make sure. Yeah, pound dollar. Last 15 minutes. So anyway, here we go. Let's take a look at this. So here it's quoted at 32.36. There's the strike. All right. That's 5 pips away from the strike. That's not that far. Here it's 62 at 72. 2024. You see the price swings that's going on. And it's all about the relationship of the underline, this line, compared to the strike. The scale's trading between 0 and 100. It's trading at the strike 48 at 52. That's the halfway point. Now look here, look at how this swings go. 19 at 23. I can be a buyer, and this is, well, I think the next slide, I mean, this is probably about, problem is I can't see the time here. It's probably about less than 10 minutes right there. I can pay 23, and that's 76 upside at expiration. Net. Okay, here the market popped up above the strike, and this is actually 10 pips above the strike. If I take a stance where I think it could go towards this strike, and you see how quickly it moves, that's a $6 cost trade right there. I sell 94, it cost me $6. It's 10 pips away. And it is, hang on, I have to look into my other slide. I think it's a little more than 5 minutes away from expiration. So you don't have to wait till expiration. You can turn around, and if you sold it at 94, you can turn around and try to buy it back at 84, or buy it back at 88, or put a $50 bid. Here, that's 3.5 pips. And as it worked out, this thing sold off down to 0. So if the underline's hanging around this strike, this is what you can expect. Huge gamma. Okay? So that is kind of an overview of binaries, but really I'll open it up to questions and stuff, but what I would recommend is that the binaries is just another trading vehicle's choice. It's a limited risk product. It has a fixed cap payout, and it's susceptible. You do know that it's going to be worth $100 at expiration, and just it's another trading choice to add to your arsenal. So, any questions? And here is, if you do have questions, you can always sign up for, send them to me directly, chip.frame@Nadex. And that's about it.